At Georgetown's McDonough School of Business, or as I call him, the pride of Virginia's Shenandoah Valley, Stanton's own Paul McCulley. Paul, it's good to have you back on. What do you expect?
Good to see you, Brian.
Thanks. What do you expect from the Fed? What would you like to see from the Fed?
Hopefully, there'll be some congruence between those two things. I expect them to do 75, and I think all the focus will be on the December meeting. And I think that Chair Powell will pre-announce that they are stepping down to 50 from 75 in December. So I think that's why the marketplace has been rallying, and I think that will be validated. And so that will be a good time, if you will. At the same time, I think that Mr. Powell will leaven, if you will, the enjoyment by stressing that they have a lot more tightening to do in 2023, that they don't want to have the market do what it did last summer and have too much exuberance. So I think he's going to deliver what the market's expecting, 75 and a pre-announcement of a step down to 50 in December. But I think he's going to press the outlook for next year to higher for longer. So I think that's the combo he's going to try to work with on Wednesday.
If you're right, and you probably are, is the market going to like that? Bond market, stock market?
I think it will validate what the markets have done over the last couple weeks. So I think that we will restore the confidence of some decent prospect, perhaps, of a soft landing. So I think it'll be good news from that standpoint. But for those who are hoping that what he does tomorrow will de facto mark the end of the tightening cycle, I think he will push really hard back against that. Because if they even give the slightest hint that what they're going to do for the rest of the year is it for this cycle, then I think they would get far too much easing in financial conditions. So I don't think that he's going to give everybody what they want, but I think he will give the market what it needs.
Apparently, and that's a good kick in the inflation teeth. The 3-month, 10-year spread, I know it sounds crazy, has basically 100% recession predicting historical thing. I mean, that doesn't mean it's going to happen again. But do you believe what that part of the bond curve is telling us, Paul? Is recession inevitable?
It's not inevitable, but I take that signal incredibly important. It is profound versus the inversion we got between the 2-year and the 10-year earlier in the year, and people kept saying, recession, recession, recession. I think once you invert the money market sector, basically the rates that you get on stuff that always trades at par versus the 10-year, that is a huge warning signal that the Fed needs to slow down the pace, not stop, but definitely slow down. So I take it incredibly seriously, and I think the FOMC does as well. You can't say that 3-month to 10-year is just, the market doing what it does. No, the Fed put the 3-month where they're putting it.
We're hearing a lot of stuff about inflation, Paul, windfall, profits, taxes, by the way, every industry has record profits because they had record demand and they didn't have to discount because everybody had money in their pocket. So that's a separate issue. To what, if I had to say one thing was the reason for inflation, how would you answer?
You only go give me one thing, Brian?
Yeah, I'm stingy. I'm Scrooge.
I think, actually, I will go with the supply side of the economy if you constrain me on that question, in that, people think in terms of monetary and fiscal policy really stimulated the demand side and that contribute to the inflation. I think that's true. But even if we'd had more temperate monetary and fiscal stimulus, particularly fiscal stimulus, I think that we would have had an inflationary response because of the supply side, which is why I'm optimistic that as we are moving out in time and the supply side corrects itself, and demand slows, that this inflation surge will, in the fullness of time, prove to be transitory.
Oh, there you go.